Hello, everyone. Good afternoon. It is Wednesday, November 22nd, the day before Thanksgiving. I hope you all are having a wonderful week. Going to enjoy some time with friends and family and celebrate everything that you're thankful for. I had a pretty light day here today, so wanted to jump on here and share a little bit about economy, market, where we see things heading into year end, share a few charts and a few things we've been looking at. So let's take a look. Right, so this first chart here is showing on the top inflation and core inflation. Looking at just the purple line of inflation, you can see we reached a high of 9% in 2022. We're now all the way down to 3.24. Core inflation being a little bit more sticky, as you're probably seeing in the news, still hovering at 4.03. But the bigger theme here is both inflation and core inflation are in a significant downtrend. Yes, headline inflation did pop here a little bit last couple months, but resumed that downward trend here in September and October. I'm still looking for a very similar number in November. All the research that we're being provided to this point suggests inflation is going to continue to come down. Looking at that bottom chart, I should say this is the biggest driver too, right? And this is going to be a common theme of what we go over here today. This has been the driver of the stock market for the last 2 years. And to see these numbers start to come down like this is a pretty important sign. On the bottom, this is the federal funds rate. Okay, so this is the rate at which the Federal Reserve loans monies to banks so that they can therefore loan money to us. They've created that tightening over the last few years to limit that lending or make it more expensive to try to cool the economy off and drag that inflation rate down. Now you can see for the last few months we've been moving sideways at 5.5%. The expectation is that the market will, or excuse me, that the Federal Reserve will lower this interest rate heading out into early Q2, maybe the start of Q3 of next year. Now, even though the Federal Reserve has not moved their interest rate, okay, interest rates have already moved in anticipation of this. Right, this is a very difficult part of the market for a lot of people to understand is like, hey, the Federal Reserve hasn't lowered their interest rates. Why is the market rate going down? Well, the market always moves ahead or anticipates where everything else is going. So the 10-year treasury rate is what we're looking at here, reached a high of just under 5% and is now down to 4.42. So that cooling off of that interest rates has therefore allowed interest rates on mortgages to cool down, car loans to cool down a little bit, being a little bit more affordable. This that top there, 30-year mortgage reached almost 8%, now down to 7.3. Still elevated based off of the last 15 years, but historically speaking, going back 100 years, if you will, that rate is pretty on par for average. Now, having said that, in the middle chart, existing home sales are down from a high of 413,000 to 394,000. The bigger move here is at the bottom chart. Median sales for new homes was 496, now down to 418. So definitely seeing some relieving of home prices as well, which should make things a little bit more affordable for people to purchase and keep the economy on a good foot. Also helping inflation come down is oil and gas. So the top is WTI crude oil. Obviously, you can see reached over $120 a barrel there in 2022, now down to 83. Now, because of that, on the bottom, U.S. retail gas prices coming down as well, $3.40 a gallon. Pretty significant downtrend, right? Yeah, we reached that $5 mark there in July of 2022. We come all the way down to 3, and then we went back to 4. Now we're at a really nice downward trend here that we expect to level off at some point. But having that cool off is a huge driver in not only inflation coming down, but inflation expectations. Okay, this is a big part of inflation is what are folks' anticipation of inflation? Because if we're all out there assuming there's going to be inflation, then we're less hesitant to pay higher prices for things because we sit there and say, well, inflation. If we don't feel like there's going to be inflation or that there should be inflation, we're more apt to say, well, I'm not going to pay that price. I don't think it should be that high. Not paying that price, right, makes whoever's trying to sell you whatever that good or service is to reduce their price because no one's buying it. Once you reduce that price, therefore that contributes to a reduction in inflation. So inflation is definitely, obviously the numbers matter, but it's our sentiment on whether or not we're willing to pay the prices being asked for those goods and services. Look at 2021. The reason why we had so much inflation was not only did we have supply shortages, supply chain was tough, but we were all flush with cash because there was a lot of money printing. Unemployment was getting a boost, and so therefore we had the money to spend those higher prices. Now that that money sort of dried up, some of that is a natural us saying, yeah, I'm not going to pay those prices, and therefore they come down. So all in all, seeing these gas prices come down is important for us to say, yeah, we don't need to be paying higher prices. Things should be getting cheaper. Back to the 10-year treasury rate. I already showed this one, but 4.98 now down to 4.42. As you recall, interest rates and bond prices are inverse related. So shifting to the bond market a little bit here, interest rates have come down, therefore bond prices have moved back up a little bit. You can see here that on the bottom, that dotted line on the bottom, the Barclays U.S. aggregate bond index was down 18.4% from its high in 2020. That's a pretty significant drawdown for bonds, which are supposed to be, kind of the buoyancy, if you will, or the protector of these portfolios, the traditional 60-40 balance portfolio. You hate to see an 18% loss on the 40% side, which is why we went short-term bonds there in late 2021, but also why you're seeing a lot more alternatives in your portfolios that we're using around those 5-year income plans that we're building, trying to find alternative strategies to not be susceptible to bond prices going down. But here we are, a little bit of a recovery in bond prices because interest rates have fallen. Jumping back, there's a long ways for interest rates to fall if inflation can keep coming down and the Federal Reserve signals some sort of easing of financial conditions, possibly even cutting interest rates into next year. There's further room for the 10-year to fall, which would mean there is further room for bonds to recover. Now, having said that, if we look at this 10-year treasury rate, this is more of a technical chart to look at this. You can see I got 3 red dots up there. Back in late 2022, 10-year treasury spikes up to 4.4, falls back down. Now here we are, late 2023, spikes to 4.4 again, kind of hesitates a little bit, and then rushes all the way up to that 5% mark. Now here we are, interest rates have fallen back down. We're back down to this 4.4 rate. Technical analysis would say historical resistance, right, which is those first 2 red dots, the market was resistant to go higher, can turn into future support. So the question is, are we now seeing support at this price and the 10-year treasury can kind of spike a little bit from here? That is a definite possibility. However, we feel, and our research partners have provided us the research that suggests that 5% rate that we saw earlier this year is most likely the peak for this cycle. That even if we get a little rush here to 4.6, 4.8, we don't anticipate getting back to 5, or most importantly, pushing through 5%. Never say never, but right now, with inflation cooling off like this, the economy slowing down a little bit, we don't feel like that is going to happen this time around, which would support now going out and going from short-term bonds to intermediate-term bonds or even long-term bonds. As those interest rates continue to fall, those bond prices will hopefully recover. Last chart is just a quick look at the S&P 500, right? The broad market index. Not a lot of time spent on stocks today because, the stock market is moving. Yes, it always does. But the catalyst to the market moving right now is not earnings or unemployment or anything like that, which typically moves the market. It's inflation and interest rates. So I've drawn a red downward trend line there from the peak in 2021. You can see that downward peak was hit or set, excuse me, in the middle of 2023. Then we pulled back here September and October. November's been really strong, but we are at a really important inflection point right now. As you can see in that last red circle on the right in the top part of this graph, are we going to be able to push through this red downward trend, or are we going to get pushed back down? So if we see a pop above that red downward trend line, that's going to signal to us a much more likelihood of a year-end rally. The research that we're getting currently supports a year-end rally, so we want to stay bullish. We want to anticipate that this market moves through this downward trend line and goes higher, but we got to be diligent and be paying attention, possibly pull a little bit off the table if we see this rolling back over. On the very bottom of this chart on the far right, you'll see a red circle on that bottom, which is a momentum indicator. Get out my picture here. So of that MACD here, moving average convergence divergence, that is showing, excuse me, a bullish buy signal. So you can see on the very far right, that is the short-term trend in the blue line is crossing the longer-term trend in orange, creating a positive buy signal in momentum there. So we're back here. Everything's positive. Everything's kind of moving in the right direction. Inflation's coming down. Interest rates are coming down. The market's back up to this recent high. We have a bullish buy signal. We are hopeful that a year-end rally is had, and possibly even looking into early 2024, that the market continue to find gains before possibly running into more of a slower economy, possibly entering a recession mid to late 2024. But we'll have a lot more on that as the 2024 outlooks start to roll out from our research partners. And then we'll obviously be providing our own here early January. So that's it. I hope you all have enjoyed. Please holler if you have any questions or concerns. Have a wonderful Thanksgiving with your family and your friends. I just want to take a second to tell our clients how much we appreciate you and thank you for the trust and support you give us. We love what we do. We're very energized in what we do. We have a lot of cool things coming down the pipe. New team members here in the next couple of weeks to months. We're really excited about some things we have going on here. So just want to say thank you to all of our clients. We appreciate you. Have a wonderful Thanksgiving, and we'll talk to you all very soon.